Okay, let's get started. For you out there on Zoom land, and for us here, which is a minority at the moment, I hope all of you are fine. We have here Tom Richards, who is the one that holds the strings on the budget for our pensions, and occasionally is able to put some extra money in, for the university at least, the university contributions. And I've already glanced at the slides, and I think you'll hear a positive story from Tom.
Yep, that's the plan. Well, thank you for having me once again to give an update. The news is good, continues to be. Can I flip to that, just that first slide? We're actually in the midst of preparing materials for the Board of Curators meeting later this month, which is actually going to be down in Springfield. So I borrowed some of the information from that, but just it's kind of a good reminder. This slide that's up is just a good summary of the retirement plan. About $4.5 billion as of the end of March. We've got 30,000 members, active, retired. That includes me, includes my wife. And I think most people know the plan that we're in has been closed to new employees since 2019. All new employees are in a defined contribution plan. Plan assets, so we have an actuary certify the plan's liabilities, et cetera, once a year as of October 1st. So this last valuation, the assets were $4.2 billion, the liability was $5.6 billion. So we had an unfunded liability of about $1.4 billion at that date. It's in kind of the funded percentage is in the mid to upper 70s, which is fine, especially given the plans that we have to get back to fully funded status. And the plan assumes a rate of return of 7%, and that's not changed. And that's a pretty conservative assumption for a public plan. And that's our next slide. Well, I got a slide, and I borrowed it again from the board meeting just because it's a good reminder. I think all of you will have an appreciation for this. When people look at what they do, they often, when they're not in retirement and they're not familiar with institutional investing, they think like an individual investor saving for retirement. And so what we like to say is, you know, when you're saving for retirement, when you're working, it's a one-way street where you're putting money into your account every paycheck or every month. You're putting money in, you're not taking any money out. For an institutional investor like us, like the retirement plan, we're more like you in retirement, where you've saved for your retirement through your whole career, and now you're at the point where you're carefully managing your cash flows. You're really not putting any more in, you're taking money out. And as you know, you all know, once you start to take money out, that changes the risks quite a bit. And typically that's why most people, as they get further into retirement, they want to take less risk with their money, because if you happen to get a big market downturn, it can have a big impact on you in your retirement. So that's the same way that we think about the retirement plan, which may be unintuitive, but it really is the same thing. I think my next slide, well, I'll get to it, where we're talking about cash flows. But just sort of a longer term view on the investment performance of the retirement plan. So on the left-hand side of your screen, we've got 3, 5, and 10-year numbers. So what we're looking at there is how did we do that top line, the actual performance, and how does that compare against our policy benchmark? So that's sort of the benchmark that's established at the targets approved by the board. And then we have the assumed rate of return. So we want to look at how we're doing against both of those metrics. If we look at the 10-year point, this is the biggest amount of history we have. So the actual return over 10 years annualized is 7.2%. The benchmark over that time was 6.3%. So that means that, like, my team and the people that we work with, we outperform that benchmark by almost 1% over 10 years, which is pretty significant. So then we have the assumed rate of return. That's what really counts in terms of the actuarial valuation of the plan. If you average it in over the last 10 years, because we've taken that return rate down, but it's about 7.3% over the last 10 years. And we're right about there, 7.2%. That's, I would call that about the same. On the right-hand side of the page, I always like to show that just so people get the magnitude of the pension plan. This is just looking at the first 9 months, the first 3 quarters of our fiscal year. So we started out at about 4.3 billion. So we put in 117 million of employer contributions and then 11 million of employee contributions. And then the first 9 months of the year, we paid out $298 million in benefit checks to all of you, maybe soon my wife. And then during that time, we made $390 million of investment income. So ended roughly about $4.5 billion at the end of March. Okay, next slide. So I think I've shown this before, and the math people will maybe appreciate it, and then maybe a lot of people will look at this and say, what the hell is that? This is just a way of looking at the long-term view of the pension plan relative to what we assume would happen statistically. So we're going back to 2017 through today, and the green line would be the return that would be assumed when we're doing our modeling. So that's what we would expect to earn when we're doing our asset allocation modeling. And the red line is our actual cumulative return. So again, from 2017 out through 2024. The narrow inner blue lines represent 1 standard deviation, and the thick blue line represents 2 standard deviations. So again, mathematically, we would expect roughly 2/3 of the time to be within that inner cone. And what do you know? That's exactly what happened. So it's just a check on when we kind of do our modeling and we make our choices. Ultimately, we want to look back and hold ourselves accountable. Did the results look like what we thought they should have looked like? And I think over a long enough period of time, it certainly does. And there are periods like in the COVID point, the beginning of 2020, where we were below, and then the markets were back. But over time is what we're really interested in looking at. So the next slide, peers. So peers aren't really super important to us because we're investing for our own risk appetite for our own pension plan. But it's useful to look at what peer universes are doing with public pensions across the country. So here's a data set of over 5 years, there were 393 participants, 324 over a 10-year period. But this just gives some perspective on how our return of the pension plan compared to the peer median. So over a 10-year period, our return, and this data is as of June 30th of 2023. So over 10 years, we were 7.5%. The peer universe median was 7.1. So just an indicator, give us a sense of asset allocation, general performance versus other peer pension plans. And then the next. So I'm not going to go into the details of all of this, but I'd say that I mentioned that we prepared board materials for the Board of Curators at the end of this month. We're revisiting asset allocation for the pension plan. And we're in actually a really good environment for that because of changes in expectations on return, which are largely driven by the fact that cash rates are kind of back to normal. Like, forget the last 10 years, but back to normal from before that. So what I would say is the 10,000-foot view of this is we have an opportunity to reduce the investment risk of the plan and still have plenty of cushion over what our minimum required return is. So kind of back to the point of thinking like a retiree, well, this is an opportunity for us to take a little bit of risk off the table so we have a little bit less volatility in the investments of the plan, because more and more as we go into the future, those investments are gonna be paying the benefits. So we'd like less volatility. The next slide, okay, so this is, I just put in a couple of highlights. We have one of our actuarial consultants do modeling that matches, the modeling matches up the liability, the payments going out to all the retirees with our assets and how we plan to fund the plan. So this is something that will be presented to the board later this month. But that next slide will show us. So you're looking at a graph on the screen. You'll see it goes out to about, well, I don't know, 2065. And each of these bars represents the net amount of cash going out the door from the pension plan. So you'll see in the beginning, 2023, ramping up year over year, then there's this big jump up, and then you see again, like as we get into the 2050s, those lines get smaller. For the most part, this is all just showing the checks getting cut every year going to retirees. And so it does give you a sense of that it'll peak in the 2040s, and then it'll start to go down. So even where we're at now, there's still quite a bit of growth ahead in terms of the assets of the plan as we fully mature. Now, this may be getting too technical, but you might ask, why is there this big jump in 2041? Well, and my next slide will actually help explain that, but the university is putting in a lot of extra money to pay down that unfunded liability. We mentioned before the unfunded liability was roughly 1.5 billion. So each of these years is lower because the university is putting a lot of cash in. So these are net cash flows out. So if everything would work out perfectly over the next 20 years, 15 years, then that unfunded liability would be paid off, those payments would stop, and so the cash would no longer be going into the plan. That's why that jumps up. So it's not that the benefit payments jump up from there to there, it's just that the cash coming in would stop.
I'm still confused.
Yeah. So these bars are net cash flows.
Right. Net cash flows.
Net cash flows.
So on top of that is about that shift that you have there is what the university puts in at this point from the years 2023 all the way to 2040.
Yes. That's like the debt service payment to pay off that unfunded liability. And then that's when the amortization of that debt ends, and so the cash coming in stops. And so these are net. The other thing that think about is at this point, it's very unlikely that there would be any active members left in the plan, like everyone would have retired. So there would be no more contributions of any kind going into the plan at that point.
So that little going up from the $1.50 going up is investment growth still, or what is that growth from then? Or is that?
So the difference in, if we look at about 2040, 2041, the difference between the 38, which is really 380 million, and then the next year is the 500 million, the difference between those two numbers are what the university was putting in terms of cash into the plan.
And it still rises a little bit from the last members that are still employed.
So it's probably the very tail end of investment growth, and then the spend down, the pure spend down begins. The last actuarial analysis that I looked at has the last retiree being paid their last check somewhere around 2100. So none of us will be around to worry about that, but our job is to make sure that the money is set aside, which it will be. So the next slide we'll get to the debt. I probably should have showed this first. So the bars on this page, again, these are from the consultant, the actuary. This is the amount of the unfunded liability as it goes down over time as we're paid. So again, that number, roughly 1.4, 1.5 billion is where we are today. The gold line going up is the cumulative amount of contributions we're putting into the plan. to pay this off. So every year as we put more money, and again, the gold line is cumulative, so the more money we put into the plan, that unfunded liability continues to drop until, again, at that same time point then, that debt is paid off, and the contributions, again, cumulative, the contributions basically stop. So what we're saying then, and this gets into the actuarial projections, that the cost to the university today to fully fund this plan, and then like the end of the contributions, is another $3 billion. So between now and then, between now and somewhere around 2040, the university itself will put in about another $3 billion, and then the plan will have no longer have active employees, and the university would otherwise no longer contribute. So our job as the investment team is to make sure, again, that the investment portfolio is set up so that we can deliver that return that we're expecting that kind of feeds into these contributions. And again, that's a 7% return. I don't remember if that was the last slide. I think, yeah, that was the last slide. So,
so it means that by 2040, it's 100% covering the money that is there, investments that are there, 100% covering whatever is calculatable as that they have to pay out.
yeah. And if we, yeah. And you know, probably one of the things that we would be preparing a future board, like, could we go back just one slide? So if you think about back around the time frame of 2040, when the unfunded liability is paid off, and we really would be at the point where the investments would be paying the benefits for the next 50 years, we would like to be able to get whoever the board of curators is at that point in time to put them in a position where, you know, again, 100 things could change, but where they'd have the opportunity to basically sell off the liabilities to an insurance company to annuitize it. So it has no impact on the retirees, but basically it would get the university out of the investment business at that point. That's a long way off. Again, a lot of things can change, but we're just trying to do our best, and we have really since the financial crisis, of minimizing the risk of this plan as much as we can and have it as robustly funded as we can. And honestly, I think compared to most public pensions, I'd say this, I always say it, we're doing things pretty well. And I think we're pretty transparent about it. Any best practice that I've ever run across in the public pension space, we're already doing it. Just as an example, again, this is probably boring to most people. Siegel is the actuarial firm that's always done the certification of the pension plan every year. So every October 1st, Siegel does it. Well, because we wanted to be super sure of the data with the modeling that we're doing, I mentioned that Millman is doing these slides. So Millman is a different actuarial firm. So we hired Millman not just to do our consulting work, but we also hired Millman to go redo the audit certification that was done by Siegel. So we hired someone to go in and audit the auditor, if you will, just to make sure that the data is completely accurate. So everything like that we could do in terms of risk reduction, making sure we've got good data, that our modeling, our projections are good, we've done. I'll mention, I may have mentioned last year, we had a program running late last year where we had made buyout offers to terminated employees.
Yeah. Yep.
So terminated vested employees in the plan. Gosh, there were, off the top of my head, there was a population of 3,000. We had a take rate of 15 to 20%. So we set out, we reached out to all these people that we could find. Well, Millman actually did the work for us. They got a modest financial incentive to take the money and cash out and roll it over into their IRA or whatever, but about 15 to 20% took that up. So
I'm trying to remember what percentage you were projecting at that time. Was it a little bit higher than that?
Probably, maybe there was a hope it was a little bit higher, but the problem, if you will, with our plan is that you can cash out whenever you want. Most public plans don't have that feature, so when they run an offer like we did, it's really a big deal. In our case, you can always cash out, but we did offer an incentive for people to do it, so that we would have paid them a little bit more than what they would ordinarily get. But the take-up is pretty low.
Only 10 to 15%?
Yeah. And that's still fine, I mean, and people get their money out and they get a little bit of a bump, but yeah.
Okay. If I look over these long time frames, even 2% inflation is going to have a major effect. These are 2024 numbers, and so the actual numbers may go up if inflation keeps on going, or what?
Well,
Do I understand that wrong?
well, so as you all know, maybe painfully lately, so there's no cost of living adjustment on benefit payments.
Okay.
So where inflation comes into play is more for estimating the wage inflation of active employees. So like in the model, and that's something that we may have to look at, is that inflation assumption, because I want to say, I think it's currently 2.2%, the long-term inflation assumption. So what that's saying is that when they're calculating the liability for me, they're planning on my wages going up 2.2%. So in this current period, you know, wages are going up at a higher rate. The question is, how long will that last? Will that affect the longer term? If it does, then we may need to tweak that assumption, which would drive up the benefit liability.
Yes.
But because there are fewer and fewer active employees in the plan, the impact of that is not significant.
So it would not pull this getting fully funded out to a later date.
No, I think, can we go back a couple slides to that cone chart? There we go. This is the big driver. So again, if you just think about over time, this green line would be that 7% return. So the risk always is, will you meet that 7% return? And then I also mentioned, you know, cash flows are a big deal when you're in retirement, because like even if I'm just pointing to the point that was the first part of 2020 when we were going through COVID, there was a pretty big dip in the return, which, you know, we lived through that period. So the issue is, again, thinking about a retiree, is when we went through COVID at the beginning of 2020, the markets dropped, the value of the investments dropped, but every month we're writing benefit checks. So that was a pretty short-lived thing, and so it wasn't that big of a deal. But if you know, think about the financial crisis, and the duration of that was quite a bit longer. And so it's whenever you have a drawdown, when markets are down and you're a pension plan largely in retirement, you're writing checks. So when the markets are going down, you're writing checks every month. And at some point, you may be selling assets to write those checks. And when you sell the assets, then when the market recovers, you've got fewer assets. So all of which is to say, that's why we're always looking for opportunities to reduce risk. And when I say reduce risk in the pension plan, what we're really talking about is narrowing these cones. So we want to narrow that standard deviation expectation so that we would expect a narrower range of outcomes. Now that also means, you know, you're giving up something with protection on the downside, you're probably going to give up on the upside, but it's those downside periods that are very painful. And again, you can think intuitively as a retiree, you kind of understand what that is. If the market's down 20%, you still have to pay your taxes and your insurance and, you know, your gasoline, et cetera. So that's the mindset that we approach this, is really as a retiree that's managing cash flows.
So Tom,
Yeah.
in one of your earlier slides, it shows that there's still some employee contribution.
Yeah.
coming through the fund. So this means that people who were hired before 2019 but have not yet retired, right?
Yeah.
So they're eligible to join the plan, but they're still making contribution
Yeah.
to the plan.
We go back
That's what
to
it
the
means?
Table, I think maybe right before this. Yeah.
It
So-
was a graph, I think. Oh, yeah,
So
there
in
you go,
the
yeah.
9 months, yeah, there were 11 million of employee contributions. So like I have money taken out of my check because I'm in the same plan that you guys are in, the
Yeah.
2012 and before. I'd say, you know, just as an aside, when we were looking at all different things to address the pension plan, we looked at increasing the employee contributions as a way, you know, should employees be paying more? Well, I guess that's up for debate, but the math is really what the issue was. When you look at the magnitude of the employee contributions relative to what the university puts in, they're fairly small on a relative basis. And then the other issue you have at the same time is that those number of active employees continues to drop pretty quickly. So mathematically, if we were to raise employee contributions further, it really wouldn't have that much of an impact on the plan. It would have a bigger impact on the employees, but it really wouldn't move the needle on the plan. And maybe share some other good news.
Okay, before we go on
Yeah.
to it, there is a group of employees that were in that 50-50 plan, the
Yeah.
hybrid plan.
Yep.
The pension part of that hybrid plan is part of this whole.
Yes. Yep.
Okay, I just want to make sure that
Yeah.
that's
Yeah.
clearly understood.
Yeah, that's from 2012 through 2019.
Yeah.
If you were a new employee during that time period, you're in the hybrid plan, half of your benefit is in here. And gosh, I was talking to someone about this last week. That hybrid plan benefit is actually pretty good. One of the things that we learned about it though is most people didn't really understand it. It's difficult to understand, but it's actually a pretty good benefit when you add the two together. The one other positive note I was gonna make about just employees since 2019, and I've mentioned this before, but again, for a new employee coming into the university today, from their very first paycheck, we take out 8% of their pay and we match it 8%. So from day one at the university, people are saving 16% toward their retirement, which is a really good thing. And if they were to stay here over time, that would put them in a good position for retirement. Switching over from DB to DC, at least in the short term, was never about cost savings. Because that 8% match is about as expensive as a defined benefit plan. It's really trying to get more certainty into the budgets so that you know what your amount, your expense is year over year, because it's a percentage, it's easier to plan for. With the defined benefit plan, there could be big surprises like there were coming out of the financial crisis, which hit budgets and things like that. But the new employees coming in, I'm just saying that they've got a pretty good plan, they've got a pretty good savings plan. Most people don't touch it. Like you can go in voluntarily and you can lower your 8% withhold. Very few people touch that. And I'm also convinced in a positive way, I'm sure we have some percentage of employees today that don't even know they have retirement savings. And you know, that's good. And maybe they'll have a pleasant surprise when they go to leave and they'll find out they've got this retirement account they didn't know they were funding. But the whole key to that was when we were doing the plan design, it was the intent to start taking out on the very first paycheck. Because if you do it on the first paycheck, then people don't notice any difference. And it's worked really well.
So can they up that figure above 8% or no?
Not for a match. The university will only match up to 8%. And whether they can put in more depends on the
That's
cap.
their own business, yeah.
Yeah, yeah.
So if they just put their own money for 6%, university still match 8%.
No,
Is that-
just
No.
6.
Oh,
Just 6. So that's why, you know, obviously we want people to do the 8% so they get the full match. And, you know, and again, it came back from, we worked with Fidelity on that plan. And it used to be, even I remember starting out working, everyone said you need to be saving 10% for retirement. Well, now it really is, you need to be saving 15% for retirement. And so that's how we ended up coming up with that 8 and 8, because we wanted people to be hitting what the retirement savings goal should be. So, but that's good. There's maybe almost $2 billion in that plan now. So I haven't actually looked at the math, but it won't take very long before the DC assets will begin to get larger than the defined benefit assets. So, anyway, any other?
Tom, looking at the bright side, what if the Dow is 45,000 in 2 years? What does that do to the curve?
You know, I thought I had a slide.
You mean only 45,000?
Oh, anyways, what you want?
If you, I'm mad at myself because I didn't include the slide, but I have a slide that's in the board materials, and it's looking at the level of the S&P 500 from 1970 through today. And it goes like a sort of a hockey stick, kind of slow, steady, small, relatively flat, and then it just ramps up like this. And against that, I took data and I plotted in the same graph the size of the Federal Reserve's balance sheet. And it goes along, you know, basically it's tiny, non-existent, and then it goes up like that. And wouldn't you know, when you overlay them, they're right on top of each other. And it goes back to coming out of the financial crisis, when first the Fed flooded markets with liquidity, and then we get to COVID, and then the federal government floods the market with liquidity, and the Fed floods the market with liquidity. Well, all during this time period, the S&P 500 is just going up at the same pace. So it makes one ask, can the Fed, well, the Fed can't continue to put that liquidity in the system. They're actually pulling liquidity out. The federal government is still piling surpluses in by running deficits. But one of the themes that we're talking about with asset allocation right now is we have this recency bias in the last 10 years. And so we want to think about the last 10 years and kind of project forward like it'll continue. But the one thing I'd caution everyone, the last 10 years was not normal. Not at all. It was very unusual, and it coincided with this massive unleashing of stimulus and liquidity. So could it continue? It certainly could. Mean reversion is a powerful thing in markets, always has been. But anyway, it is, again, I apologize I don't have the visual, but it's pretty stunning to see over a relatively long period of time this pretty, relatively small growth in equities. And then if you look at the period, the decade of the 2000s, which is not that far back for us, right? From January of 2000 through December of 2009, the S&P 500 over that entire period of time was flat. There was zero return for 10 years. All right, so again, we're thinking about the last 10 years and whether it'll continue, but just keep in mind the last 10 years is not normal. And even like, you know, as we talk about cash rates in the Fed funds rate, you know, we keep talking about how this Fed funds rate is back to being so high. It's really not. You know, if you go back in history again and you discount the 10 years coming out of the financial crisis, cash rates now right now are pretty normal. I mean, who remembers what your first mortgages were? We've got 7% mortgages. I mean, I had a 7% mortgage back
8.6.
See?
13.
13,
I was in your group, Bob, 12 3/4.
Yeah. So you guys all remember this, but it's like now the world's going because mortgages are at 7%. It's not that unusual. It's the last decade that was unusual, but most people don't really have that
So
perspective.
what year did the inflection J shape occur in that?
Starting like 2009,
2009, okay.
back when the
It's gone
Fed,
up and since then it's gone up.
yeah.
So
You
end
know,
of the
it-
recession, 2008.
Yeah, and now, but then the stimulus poured in.
Right.
So who knows? I can't predict markets, and I don't. But I'd just be cautioning against the idea that stocks will just keep going up. Good. My last useless trivia point, the S&P 500 so far, I don't remember what it's up year to date, but 35% of the return of the entire S&P 500 this year up to now is NVIDIA. So it's one stock is 35% of the return of the whole 500 stock index. So if you had NVIDIA, you're doing really well. But a lot of stocks are not up. So any other questions or anything online? Happy to get into.
Anyone out there, if you speak in your microphone, we'll hear it here.
I'll say we have the system came up with this new branding thing, and I mentioned I just moved into new office space, so I have this up on my wall when you walk into our suite. So we've got the UMKC logo right inside our door. But otherwise, always happy to come and visit with our friends at UMKC.
Yeah, hello?
Oh, yeah.
Hi, you mentioned something about changing over to another insurance, and I was wondering, I didn't catch the time frame on that. Did you say 20 years or more?
So yeah, so that I guess what I'll say is that is an idea that would be 20 years into the future, and it wasn't that there's certainly no decision. It's just if we do our job managing the plan well and getting it to fully funded, then that would be an option for the university to consider at that point. But no, we're talking probably at least 20 years into the future.
Okay, that's good to hear. Thank you.
Yeah.
Having no more questions, I'm going to thank Tom. Thank you very much for your annual visit to us. And it's good to see that the worries that people have, yes, the plan is not fully funded, that it's going to be that if you live long enough.
Well, thanks for having me.
Have a nice day, all. And I'll put the recording on the website. Thank you. Bye-bye.
All right. Thanks for having me.
Matt, we have
Good job, Doc.